Hello everyone and welcome to this video. Today is 18th of December 2018. It's about 9:30 a.m. Eastern Time. So in this video we're going to have a look at the pair Australian dollar to the New Zealand dollar right over here. So as you can see on this chart, it's the hourly chart that we're looking at right now. So currently the price stands about at 1.0476. This is the current price, almost at this area. And what we're going to look is the price structure or the price pattern over here. So as you can see over here, at the low of 10th of December, from that low back in 10th of December to the high that we just reached on 14th of December, we have a move over here at this area. So if you look closely, you can easily count this move as a 5-wave advancement. So easily you can put wave number 1 here, wave number 2 here, a massive wave number 3, correction, which over here has a pattern of a flat, maybe a regular flat, and finally a 5-wave. So this 5-wave advance can be labeled as an impulsive wave. And what has happened after an impulsive wave? Probably a correction. You can label this as wave A, this is wave B, and this is wave C, according to Elliott waves. Usually wave A equals wave C, but sometimes it can be 1.618 larger than wave C. So both scenarios can happen. In this case, probably the second one. So the C wave actually is 1.61 times the A wave, or the vice versa can also happen. So over here, I can count this as a probably ABC zigzag correction. What happens after a zigzag correction? Usually another advancement follows. This is one of the probable counts that you can do. One can also argue that the move to the downward is like an impulsive wave. This is number 1, this is number 2, and currently we're experiencing wave number 3. If this is the case, the prices will continue to go down and also break this level. So what can we do to take advantage of this opportunity? In my opinion, I believe this can be a bullish opportunity, which can also be have a limited risk. So a bullish opportunity with a great limited risk. But why? Because you can easily put a stop loss over here. So at this current price, if you buy the pair, put a buy order at this level, and the prices will go down, and if the prices go down, the maximum you will lose is about 50 pips, which is actually not that much. But if the bullish opportunity, the bullish case, proves to be true, then there is lots and lots of potential to the upside. Because this 5-wave advancement was 150 pips, if this pair proves to be bullish and goes up and breaks this level, you can expect at least 150 pips of reward. So if you want to easily count the risk to reward ratio, you can actually count it as like you're taking 50 pips of risk and 150 pips of reward. So it's 1 to 3. So you're taking 3 times the reward than the risk. And that's an excellent opportunity. Buying at this level, putting the stop loss right over here. And if the pair goes down, you lose 50 pips. If it goes up, at least 150 pips. But why at least 150 pips? Because if this whole advancement is a wave number 1 and this correction is a wave number 2, the next move will be on wave number 3 to the upside, which is a massive move, and usually it goes to 1.618 of the size of wave 1. So if wave 1 is 150 pips, expect maybe around till 300 pips of profit in the other waves to come. So wave number 3, if it's under wave, maybe around 300 pips can be your at least take profit. So by buying this pair and putting the correct stop loss at this area, you can easily expect a reward of 3 to 6 times the risk you're taking. And this is an excellent opportunity, in my opinion. It doesn't happen that much often. And the good thing about this pair is that it usually requires like lower commissions, lower swaps, and it doesn't move that much significant. So the pair by itself, it's a low risk pair, and putting the stop loss over here will decrease the risk even more. So I believe this is a very great opportunity to buy the pair at this current level and put the stop loss over here and the take profit at 150 to 300 pips above this current price level. Let's move on to the next chart. This is the monthly chart of the same pair, the Australian to New Zealand dollar. The only thing that I wanted to show you is that after like the big decline from like around maybe 2010 to middle of 2015, over here you can see a big move to the upside. So this is the monthly chart. In order to have a closer look at this, let's move on to the weekly chart. Over here in the weekly chart, this right here is exactly what you've seen in the monthly chart, the big advancement that you have seen over there. So this can easily be counted as an impulsive wave. It really looks like an impulsive wave, a 5-wave impulse. And after the highs reach in middle of 2015 till this very moment, you can see the price is in a range. So it's in a correction and also a range from there till now. So it's liable to break out to either way, either to the upside or downside. Which one is more likely? In my opinion, to the upside. Why? Because over here, let me erase the markers, because this move is an impulsive wave, in my opinion. After an impulsive wave, we have the correction, and after the correction, we have the continuation of the previous move, which means in this case to the upside. And also, if you have another closer look, the most recent decline in this pair looks like to have a pattern of a double zigzag, maybe another A, B, and C. And more importantly, it has broken the previous low over here, and it has made all its way down to this low. So not only this pair looks bullish at the hourly chart, more importantly, it looks bullish in the weekly chart. So if I jump into this pair and buy and put a buy order, in order to distribute my risk or diversify my risk, I will define 2 stop losses. So 2 stop losses will be defined. One will be back to the hourly chart. One of the stop losses will be here. So part of my trades, probably half of them, will have a stop loss over here at 1.0435. But because I also believe that in the weekly chart, the pair is still bullish, even if the low over here is broken, I will still stick to some of my buy orders. Why? Because the overall picture is bullish, and I will put the stop loss for my other buy trades at this level. which is 1.0232 area. And even if I want to take more risk, I can put the stop loss at 1.00 area. So two other stop losses can be defined for this pair if you're looking at it as a long-term buying opportunity. So for the short term, it looks bullish, and the stop loss is only 50 pips lower from now. For the long term, the stop loss is a little lower, means more risk, but if it proves to be a bullish after here, the minimum pips it can move to the upside is about 1,500 pips. So if you're looking from the weekly chart, it means for the next year or so, in the next 6 months, it's possible for this peep to have a 1,500 pips advancement, because it has to break this level and it should go at least the size of this, at least, even maybe more. So 1,500 pips is the take profit from the weekly, and the stop loss can only be around like 250 pips lower. So maybe almost, how much can you say, 5, 6, maybe 5, 6 times, around 6 times. You have a risk reward of around 6, 1 to 6. So if you're taking a risk of 1, your reward will be 6 times. So over here, even if you look from a long-term perspective, if you get your buy order here and put your stop loss at this area, which I believe is the best area to put your stop loss, the pips you will lose in case it goes down will be around 250 pips. But if it goes up, at least 1,500 pips. So the reward will be 6 times the risk. And this is a great opportunity, which I believe it's worth taking, and I will jump in this trade, at least for the short term. So overall, long story short, bullish opportunity in Australian dollar to the New Zealand dollar, whether it's in the hourly chart or the weekly chart. Okay, so that's it for today, guys. I hope you enjoyed this video. Thank you so much. See you next time.